Are you interested in buying a home here in the next year or so? Hey, congratulations. I want to share with you just kind of a step-by-step process to get you prepared to buy your first home. You know, it's interesting. One of the first questions that we always get is now a good time to buy? And here's a recent study that came out from Fannie Mae that talked about 86% of respondents said now is not a good time to buy. 44% of respondents to a Business Insider survey said the housing market will crash within a year. New York Times, they're talking about renting is better than buying in most markets. And the National Association of Realtors is talking about affordability being at its lowest levels from 1989. Are you now excited to buy? Hey, all kidding aside, what we want to be able to explain is that the right time to buy is when you're ready. This whole idea of fear of missing out or just missing the market and all interest rates and home prices, all of that is irrelevant. If you're ready to buy and it ultimately makes sense for your budget, then you need to take that step. But that step isn't for everyone. And that's why we want to go through these next few slides just to give you an idea of how to prepare yourself to purchase. So the first thing I always like to kind of give some context to is what's the real value of homeownership? In a recent survey released by the Federal Reserve, the average homeowner's net worth is about 40 times greater than that of the average renter. There's no rent shame here, okay? Again, renting for certain folks is the right decision. But when we talk about long-term wealth accumulation, for the overwhelming majority of Americans, that's going to be wrapped up in real estate. And that's where getting comfortable and understanding your numbers puts you on the path to being able to start to build some equity in something that is your own. Now, housing is incredibly personal to me. For those of you who don't know me, I'm Michael Rodriguez. I run the Rodriguez team here in Las Vegas. And it truly is the Rodriguez team. I work with my wife, Kelly, my oldest daughter, Tatiana, who joined the team after she graduated from college. And those three little faces, we commonly refer to them as corporate. That's Sophia, Pax, and Ellie. And why housing is so important to me personally is, as a young person, my family had some challenges as it relates to managing finances. So about 5 or 6 years old, my parents lost a property to foreclosure. They had filed bankruptcy a couple of times before I turned 18. And while they made some choices that they probably, in retrospect, would have gone a different direction, one thing I do know to be true is that they received some incredibly bad advice from the folks around them, and unfortunately, and turned my parents into lifelong renters. So one of the things that we're committed to is making sure that not only do we give you information, but more importantly, we give you context. And I'm going to give you the same advice I would give to my brother or sister. So with that, this is just a simple flow chart of how the mortgage experience works. And we're really going to hang out in this apply kind of pre-approval stage today, just again, to get you prepared. So with that, when you apply for a home loan, that loan is made up of 3 equal parts. So your income, which basically is your ability to repay. Your assets. So what money do we need to verify to get you qualified for the loan? So think about your down payment, closing cost, and such. And then the last piece is the credit. So when you apply for a loan, the credit score is one of the foundational pieces that we are going to look at in order to determine how much you can get qualified for. So with that, kind of going back to the income piece, the first thing that we're going to look at is your debt to income ratio. And simply put, debt to income is just a math problem. We're taking your gross monthly income, so gross income being before there are any deductions taken out for taxes, your health insurance and such, and we're taking that and we're comparing that to your liabilities. So the simple example I like to provide is if you make $10,000 a month and your liabilities are $5,000 a month, then you have a 50% debt to income ratio. Now, the liabilities that we are looking at are your home loans, your credit cards, student loans, and any auto loans. So think about stuff that's specifically reporting to credit. So I like to have people understand that when we're looking at that gross monthly income, what we are not typically accounting for are your utility bills. We're not accounting for your childcare expense, maintenance and those types of things. So it's important for you to understand that the 50% threshold is typically going to be the cap for most loans. So we do not want to see that debt to income ratio exceed that 50%. So when you're working through your numbers at home and trying to determine a budget, make sure that when you're looking at things, you keep your debt at or below 50% of that gross monthly income. Now, when it comes to income, what are we looking at? One of the misconceptions that people have is that they need to be on their current job for 2 years in order to qualify for a home loan. That's not necessarily true. What we're looking at is that you are in the same line of work for the last 2 years. So if you're a nurse and you worked at a couple of different hospitals, as long as you've been a nurse for the last 2 years, that's what we're looking at. Same thing if you're a teacher or any other profession, we want to make sure that typically you're in that job for at least the last 2 years. Now, when it comes to variable income, what we refer to as, overtime, bonus, commission, that's where that income can typically be used to qualify. But again, the lender is going to want to see 2 years receipt of that income before it's considered stable. So if you have a new job and you've now just started recently working overtime or you receive a bonus or commission, if you've not met that 2-year threshold, high probability that income, even though you're earning it, it's not going to help you to qualify for your new home. Now, when it comes to our self-employed folks, same kind of deal. What we want to look at is a 2-year history of you being self-employed, again, to show the stability of the income. So self-employed folks, it's a little bit different because you're not going to receive a paycheck stub every couple of weeks. We're going to actually just look at your tax returns, your file tax returns, and average your income over the last 2 years, the income that you've claimed on that tax return in order to qualify you. Where it can get tricky is as a self-employed individual, your business might bring in $250,000, but if you have $150,000 worth of deductions or expenses, then your qualifying income is only going to be the $100,000 that you actually pay tax on. So self-employed folks, we definitely want to make sure we have a conversation with them early to prepare them to purchase. And now over the last few years, with the gig economy, there are a lot more folks that are working multiple jobs. So back to that whole 2-year deal. So if you're working 2 jobs, we're going to want to see a history of you working 2 jobs for 2 years to make sure, again, that income is stable. Because what the lender is trying to avoid is somebody that is taking a second job to qualify, but they don't have a history. So obviously it's a lot more time and effort. So we want to make sure that you're able to maintain that for at least 2 years before that income is considered eligible. Now we get into the assets. Again, think money that we have to verify for your down payment and closing cost. Typically, that's going to come from one of 4 buckets. You're going to look at your traditional savings. So money that you're just taking out of payroll that you're putting into your savings account, or when you receive your tax return or anything along those lines. Next would be a gift. So if there's a family member or close family friend that wants to contribute towards your purchase, there's a very specific process that we would want to follow, but gifts are allowable. Same with your 401k and retirement. 401k IRAs do have some special provisions for first-time homebuyers where you can take a distribution out of your retirement account, and there are some tax benefits or some tax efficiencies that can be created where the government will waive the 10% penalty that's typically applicable if you take a distribution out of your retirement before you're 59 and a half years old. And the last piece is down payment assistance. At any given time here in Nevada, there are about 8 or 10 different assistance programs that are available. So during your normal pre-approval process as the lender, we're going to do all of the due diligence to make sure that any and all applicable programs that you're eligible for, that ultimately we're going to make sure we share that information. Last thing I want to share with you here pertains to the credit. Now, when you apply for a home loan, we're going to pull what's called a tri-merge credit report. Fancy way of just saying we're going to pull the 3 main credit bureaus, Experian, Equifax, and TransUnion. Now, the way that we look at the credit scores, a lot of people believe that we average the scores. That's not necessarily true. What we're looking at is the middle credit score for the purposes of qualifying. Now, if we have multiple borrowers, husband and wife, brother, sister, whatever it is, we're going to use the lower of the middle credit scores to qualify. So we could have a spouse that has an 800 credit score and the other spouse has a 650, and we're going to use that 650 credit score for the purposes of qualifying. So again, when it comes to credit, we always want to make sure that obviously we're paying our bills on time, keeping our account balances as low as possible, and that's going to help maximize your credit score. Now, the last piece I want to get into is just understanding your cash to close. I've talked about your down payment and closing costs. Think of it as two buckets. The first bucket being that down payment, which is the money that's required for you to qualify for your home loan. And that second bucket, those are your closing costs. You have about a dozen different people that work on your behalf to help get your home loan closed, and there are costs associated with their services. So the one thing you always want to make sure that when you're applying for a loan and you're going through your numbers and your budgeting, that you're budgeting for that true cash to close, so the down payment and closing cost. So here's just a couple of examples of some of the more popular loan programs, and just want to kind of work through this. So FHA is a very popular home loan, specifically with first-time home buyers. It only requires a 3.5% down payment. But what makes FHA unique is that the loan is backed by the federal government, meaning that if there's a loss incurred by the lender, the government has insurance to help offset that loss. So with that, even though you're only required to put the 3.5% down because of that government insurance, your interest rate is comparable to somebody that's putting 20% down. So the loan is very affordable in terms of the upfront investment, but also the monthly payment. And one of the beautiful parts about FHA is that they're incredibly lenient when it comes to your credit and your debt to income ratio. So that's why it's become such a popular program. Next, we want to talk about the VA loan. The VA loan is for all of our active duty and retired veterans. The VA loan does not require a down payment. So you're only responsible for the closing costs when you're purchasing or when you're utilizing a VA loan. And then the last piece is a conventional loan. One of the big misconceptions we deal with is that people think you have to have 20% down in order to qualify for a home loan. That is simply not true. A conventional loan will allow you to purchase with as little as 3% down. Where the 20% piece comes into the narrative is at 20% down, the buyer is no longer required to pay what's called mortgage insurance. So mortgage insurance is different than your homeowner's insurance. Homeowner's insurance, God forbid your house burns down, the insurance company is going to help rebuild your property. Mortgage insurance is a premium paid for by the homeowner that insures the loan against default. So like we mentioned earlier with FHA, if there's a loss against the loan, there's an offset. And with conventional loan, it's a private mortgage insurance. So it's not backed by the government. But again, if there's a loss, the lender does have an ability to offset that. And the beauty of the conventional loan is once you get to the 20% equity, that mortgage insurance will fall off. So each of these loans, there are pros and cons, but you want to make sure that you do all of the applicable due diligence to make sure you find a program that works best for you. So with that, there are several other steps to being able to complete the home buyer experience. We're going to have another video that kind of goes through things once you're pre-approved and you're out shopping. We really want to start to break down what it means to negotiate the contract and then ultimately work through the final phases of the loan experience in order to get your keys. So if you have any other questions, drop them in the comments, but we would love for you to subscribe, and we'll talk to you soon. Thanks. Bye.